Today, we're analyzing a report titled AMC Revenue Beat, Why Wall Street is Wrong. It's all about debunking the AMC bankruptcy narrative. And the argument really leans on the big Q3 revenue beat, the debt refinancing, and that strong Q4 movie slate.
The Holy Trinity, as they call it.
Exactly. So let's just jump right in and look at how we can strengthen that core thesis.
Sounds good. I think the foundation is there, but, in a story this volatile, every single number has to be rock solid. You can't just rely on the narrative.
Absolutely. And that leads us directly to our first major point.
Right.
The report needs to more explicitly bridge that Q3 revenue beat with the absolute destruction of the long-term bankruptcy thesis. It's all about quantifying those operational improvements.
I agree completely. The report does a great job highlighting the headline numbers, right? The $1.3 billion in revenue.
6% over expectations.
Exactly. And that record high admissions revenue per patron, the $12.25. Those are, they're fantastic data points.
They are.
But the weakness here is in the assumption. It sort of assumes those metrics are enough proof that the bankruptcy story is dead wrong. And it doesn't quite show how that one good quarter translates into a sustained material improvement in the company's liquidity position, especially, when you've got a multi-billion-dollar debt load looming in the background.
It feels like a missing step, doesn't it? You're making a jump from great popcorn sales this quarter to bankruptcy is impossible forever. And for a skeptical investor looking at that, $365 million cash on hand, that's a big leap.
A huge leap. So the suggestion for improvement here is to really integrate a clearer analysis of the operational cash flow trajectory.
Okay.
Or even free cash flow improvement to demonstrate that this is sustainable beyond just Q3. You have to explicitly connect that operational success, like the record revenue per person, directly to a measurable reduction in cash burn.
So showing the velocity of the change, not just a single snapshot.
Precisely. That's what really fights back against the short thesis.
That makes a lot of sense. But how do you do that? How do you model that without having access to, all the internal details?
Well, you don't need every detail. You just use the data that's available to create compelling, rough estimates.
Okay, so give me an example.
Sure. So for a concrete example, instead of just stating the Q3 revenue number, the report could add a comparison. Show the Q3 operational cash burn versus, say, the previous quarter.
Showing the trend line.
Showing the trajectory is crucial. Or even better, you could use that $12.25 per patron number to model a rough increase in the operational EBITDA margin. That directly links the small beat to a tangible financial resilience.
Wait, hold on. For a company like this, with so much debt, why is modeling EBITDA margin more powerful than just looking at free cash flow? What does that specific metric tell a sophisticated investor?
That's a crucial distinction. And it's a great question. Because for a company carrying this much debt, especially debt that's just been refinanced, free cash flow can still look negative.
Right, because of interest payments and CapEx.
Exactly. But EBITDA margin, that isolates the core profitability of the operations. It shows you if the fundamental business of selling tickets and popcorn is healthy before all the financing costs are factored in.
I see. So it separates the operational turnaround from the historical baggage of the capital structure.
You've got it. When analysts see that revenue per patron driving up the EBITDA margin, they see proof that the core business model is working. And that gives management time and options to handle the debt.
That makes the argument so much stronger. It's highly actionable feedback.
It really is. It turns a nice-to-have operational stat into hard financial evidence.
Okay, so if the first fix is about proving financial velocity, the next big hurdle has to be the structural one.
And that brings us to the shareholder vote.
The December 10th vote. Yeah, this is probably the most sensitive topic in the whole analysis, especially given the audience.
Absolutely. You're talking to momentum traders who are, let's say, extremely sensitive to the idea of dilution.
For an analysis this robust, targeting smart investors, the section on that vote needs a much more balanced exploration of both the opportunity and the inherent risk.
Right.
The report frames the vote to increase the authorized share count only as a safety net. It says it gives AMC the tool to raise cash and takes bankruptcy off the table completely.
And the weakness there is that, it's not wrong strategically pushing debt maturities out to 2029 and 2030 was a huge win. But that framing just minimizes the very real immediate market reaction to potential dilution.
It sort of glosses over it.
It does. And by ignoring that downside, the report risks losing credibility with value investors who demand a full 30-60-degree view of risk.
I like the bullish framing, I do. Calling it a safety net sounds great. But is it realistic? For a high-debt stock, won't smart investors just see any share issuance, even for hedging, as potentially reckless dilution? We need a solid defense for that.
That skepticism is exactly what the analysis needs to address head-on. If you don't acknowledge the trade-off, the reader is just going to feel like the analysis is biased, or worse, incomplete.
Okay, so what's the suggestion?
Pressure from dilution. Acknowledge it, but then immediately reinforce the long-term strategic necessity of having that tool available. You have to explicitly address the trade-offs.
So we turn a potential negative into a necessary cost for long-term survival. But how do we make that feel proactive instead of just reactive?
You position it as managerial optionality. That's a concept that is highly valued.
Okay.
So a concrete example would be to introduce a clear counterpoint. You'd explicitly state that while, yes, dilution is a concern, the ability to issue shares gives management flexibility not just to avoid failure, but to seize opportunities.
Like what, specifically?
Like paying down high-interest debt proactively to slash those interest expenses. Or funding accretive growth, like maybe strategically acquiring some close competitor locations on the cheap.
Ah, so that transforms the safety net from a shield against bankruptcy into a tangible weapon for competitive advantage.
Exactly.
It's not just a hedge anymore. It's an option for immediate liability reduction or strategic expansion.
Precisely. And by doing that, you strengthen the whole argument because you've addressed the counter-argument directly. And that builds credibility with everyone, even the people most worried about market mechanics.
Okay, let's shift gears. Let's talk about a critical issue of tone and style, specifically how the analysis explains the financial losses.
Right.
It's trying to neutralize that big headline number, that $298 million net loss, which is absolutely crucial for the whole why Wall Street is wrong thesis.
This is a delicate part of the analysis. You know, the intent to simplify complex finance for a retail audience is good, but you can't sacrifice precision.
I agree. So the report attributes the net loss to non-cash accounting charges related to refinancing debt, and then it describes it dismissively as paper money moving around. And look, at a high level, that's factually correct. But the language, that highly informal phrasing, it just lacks the financial precision you need to immediately shut down that negative headline.
That phrasing is the weakness. I'm curious, why do you think that specific phrase, paper money moving around, is so damaging? It sounds simple, but it really undercuts the analysis.
It's about perception, I think. While it's simple, it implies a certain carelessness, like the analyst doesn't really grasp the gap requirements behind the number.
Right.
For a value investor reading that, seeing a nearly $300 million charge described as paper money moving around, it suggests the analysis is prioritizing emotion over accounting rigor. It makes it sound like the company is just masking problems.
Instead of successfully executing a complex financial maneuver.
Exactly. You've just hit on the core risk. You alienate the very audience you need to convince.
So the topic sentence holds. The explanation of that $298 million loss lacks the precision it needs to neutralize the headline.
So the suggestion for improvement here is pretty clear.
Use more precise, formal financial terminology.
Right. It will lend so much more analytical weight to the point, and it clearly separates this one-time event from the operational cash burn they're trying to reduce. The goal is to elevate the language, but, without becoming totally inaccessible.
Exactly. You have to connect the loss directly to the positive strategic move they made.
Okay, so how would you rephrase it?
You'd want to specify that the charge likely relates to a loss on extinguishment of debt. That's a mandatory accounting adjustment. It's required by GAAP when you successfully push out debt maturities to 2029 and 2030.
And why is using that specific phrase, loss on extinguishment of debt, so much more powerful?
Because it completely reframes the narrative. The word loss suddenly becomes a technical byproduct of a successful operation, the refinancing. It signals to a sophisticated investor that the company took a necessary, non-cash hit in Q3 as the required cost for securing that long-term runway and reducing immediate pressure. It transforms the excuse into a specific, non-recurring result of a positive move.
That's extremely effective. It frames a negative number as, basically, the receipt for a success. And that ties back perfectly to the second point about debt management.
When you combine that kind of precision with the strength of the Q4 Holy Trinity argument, the sheer box office power detailed in the analysis,
Yeah, linking the films, the IMAX and Dolby.
Right. When you put all that together, the bull case becomes incredibly difficult to argue against. The author has the narrative foundation, we're just making sure the financial tools are sharp enough to cut through the noise.
Agreed. And the strength of that final section, the focus on future catalysts, that's a real high point. It shows a deep understanding of the box office pipeline.
It really does. It successfully identifies that forward-looking momentum, which is what drives trading decisions, not just yesterday's results.
Excellent. So, to summarize, the 3 core actionable suggestions we have for strengthening this analysis.
First, on financial velocity, quantify the Q3 beats effect on operational cash flow. Show how that $12.25 number translates into a measurable reduction in cash burn or an improvement in EBITDA margin. Prove the core business is healthy.
Second, on the structural risk, add the necessary nuance to the discussion of the December 10th vote. Yes, it's a safety net, but the analysis has to address the dilution trade-off. Frame it as a proactive option for debt reduction or growth, not just a passive hedge.
And third, on analytical precision, refine that description of the $298 million loss. Ditch the informal language and use precise financial terms, specifically loss on extinguishment of debt, to frame that charge as the required accounting outcome of a successful strategic move.